Hello, welcome listeners and market participants to KBRA's European Credit Podcast, Conversations in European Credit. I am Gordon Kerr, Head of European Research at KBRA, and today I am joined by Kali Sirugudi from our RMBS ratings team.
Hello, thank you for having me on, Gordon.
Always great to have you on, Kali. Today we will be covering a topic that should be on every securitization investor's minds. Can the growth of specialist lenders continue as a part of the securitization markets? The question has been raised and answered within a report that you can find on KBRA.com titled UK RMBS Growth of Specialist Lenders to Continue by Kali and his colleagues. The RMBS team and I have been publishing regularly on the various topics facing the RMBS market in Europe, including the popular look at mortgage market trends in the UK or Ireland, or a look at the equity release market or the buy-to-let markets, all of which you can find online. So on the topic of specialist lenders, Kali, let's get going. Post-global financial crisis, just a handful of specialist lenders survived the aftermath of the scrutiny into subprime lending practices and the withdrawal of credit lines to originate mortgage loans. While the surviving specialist lenders were largely forced to stop new lending, they reinvented their operations into strong servicing teams, servicing their own portfolios of pre-crisis origination and/or taking on third-party servicing mandates. Now, with the help of the securitization markets for funding, new specialist lenders have emerged, and those that were already in the market have expanded into new lending and new asset classes. So, Kali, first let's start with what these specialist lenders now cover.
Thank you, Gordon. So the specialist lending sector has been active in SME finance, mortgage lending, and other types of consumer credit. In the mortgage lending sector, the SLS has supported the underserved borrower demand for house purchases and remortgages. Banks and building societies using automated lending models tend not to lend to some of the borrowers with more complex income streams, often overrepresented in self-employed borrowers, borrowers with adverse credit history, older borrowers, borrowing for business purposes, and secondly in lending for the purpose of debt consolidation, refurbishment of property, or equity release and other reasons. Such borrower segments are the key targets for these specialist lenders, which has also played a significant role in supporting the demand from landlords, individuals, or legal entities in the buy-to-let sector. In recent years, specialist lenders have also revived lending to older borrowers through later life mortgage products like equity release mortgages and interest-only retirement mortgages. Bridging and development finance, which is relatively riskier, has grown over the last few years with specialist lenders using bespoke underwriting to address the higher risk. Banks and building societies generally view such borrowers or loan products as relatively riskier and more difficult to underwrite. But the specialist lenders have established manual underwriting norms, which are important for understanding borrower circumstances and enabling risk mitigation. In effect, these specialist lenders have created their own niche in the UK mortgage market by catering to this underserved borrower segment through a variety of mortgage products, each differentiated to suit the needs, credit history, income, and age profile of the borrower and the legal status.
Okay, great. So that gives us a good sort of overall picture of where these guys have come into the market. But let's dig a little bit deeper in terms of the actual lending that they are offering. What are the mortgage products that they actually offer and how do they lend into these niche markets?
Right. So some of the prime borrowers in the market may not get a favorable outcome from banks and building societies, which use automated decision models to screen an application. Some of the reasons for the unfavorable outcome could be aspects like applicants not registered on the electoral roll, limited years of credit history, or aspects which may have possible credit implications like non-UK citizens or more than a threshold number of applicants on the mortgage application, limited impairments in credit history, or non-standard property type or location of property in floodplains. On the specialist lender sector, in comparison, predominantly use manual underwriting and weigh variations on loan features and borrower profile to assess credit. Other variations considered through the manual underwriting process could relate to whether the property is freehold or leasehold, valuation types, other than the full survey evaluations like those using automated valuation model method, drive-by, or desktop. Such originations in general may get categorized as near prime given these variations. Now, KBRA views these as near prime expansions by the specialist lender sector, as we have talked about this in the report. There can be other considerations, like you have demographic trends in the UK provide a supportive background for the development of equity release mortgages as a product for later life lending, where the specialist lending sector has been at the forefront. Product innovations like interest-only retirement mortgages have emerged to provide options to borrowers to fund lifestyle choices, later life care needs, or remortgage options for mortgage prisoners. House price appreciation in the UK has provided a large store of wealth available as collateral for this later life lending. The specialist lending sector exhibit appropriate flexibility on affordability measures, for example, top slicing for buy-to-let borrowers, where the disposable income of the landlord, in addition to the rental income from the property, is considered to test the buy-to-let loan affordability. For owner-occupied loans, several borrowers could be considered for applications where income of all the applicants is considered in the affordability assessment. Such cases may not receive a favorable outcome with banks and building societies. Purpose of a loan, and as regards this aspect, the specialist lender sector has expanded to financing business end use or debt consolidation, whereas banks and building societies would traditionally provide mortgage financing for property purchase or free mortgage. Riskier second lien lending or bridging and development finance are areas where the specialist lending sector has been innovative and exhibit a bigger risk appetite for lending. The specialist lending sector typically mitigates such riskier lending using lower loan amount limits, lower LTVs, higher risk-based pricing for such lending, and robust arrears management strategies. So this illustrates the lending flexibility which has enabled specialist lenders to carve a niche in the UK mortgage lending market.
Very interesting. Now, turning to the securitization markets and the capital markets efforts by these lenders, they've been very active since 2021. The run rate of issuance numbers for specialist lenders has been better than banks and building societies in the UK. And one reason for this is that securitization is a key source of long-term funding, as specialist lenders don't have access to the same funding as banks with their large deposit base and capital leverage. And further, banks and building societies have benefited in recent years from the Bank of England, particularly during the pandemic period. The Bank of England offered refinancing facilities to banks and building societies to help their funding and liquidity, which would not have been offered to the specialist lenders. Covered bonds remain the main capital market mortgage funding choice for banks, with a higher amount outstanding currently in comparison to the amount of UK RMBS issuance that's held by investors. And the specialist lender sector's share of issuance volumes by amounts has grown steadily and stood at 37% of all UK RMBS issuance in 2023. Now, we expect that this issuance share may decrease in 2024 and 2025 as the run rate of loan originations has decreased due to affordability issues and higher interest rates, and by the return of the banks into the capital markets and securitization markets as well. But the actual issuance volumes is likely to continue to be supported by refinancing of existing transactions and the fact that their specialist lenders are in need of this type of funding and financing to help maintain their portfolio turnover and as a source of actual financing. But if we actually turn to the reasons for this in terms of the funding side of things, how do specialist lenders manage the margins as they expand into these various markets?
Okay, so this is a complex question to answer, and we've dealt with this in a bit of detail in the KBRA report on the sector. But let me take an attempt to answer this question directly. The specialist lender sector originated mortgage rates are higher in comparison to those offered by banks and building societies, mainly due to the risk premium associated with products to underserved borrower and the issuer's individual funding costs. The prevalent swap rates in the market has an influence on the mortgage offer rates by the specialist lending sector. The excess spread of mortgage rates over the issuer's liabilities, including the interest liabilities on notes issued and the fixed rate payable under a fixed floating swap in a transaction, can vary the size of Class A notes issued. Now, using the margins on the Class A notes, which have been issued, as a proxy for the cost of funds for the specialist lending sector over time, this cost of funds showed a peak at 1.7% in 2019, just prior to the pandemic period. The average then nearly halved to 0.9% in 2021, and it remains at a lower rate than pre-COVID levels at approximately 1% so far in 2024. Now, this decline in average cost of funds coincides with lower credit enhancement levels for the Class A notes, falling from a peak of 19.2% in 2017 to 12.9% in 2024. And we've depicted such variation across years through some illustrations or charts as well. In the KBRA report, we considered 19 specialist lender issuances or shelves spanning 14 lenders and 82 individual transactions over the period 2016 to date. KBRA views this tightening as partly a result of better than expected resilience of borrowers to the COVID financial stress and the growing confidence in the quality of the specialist lender sector originations, given the performance history so far. The increase in margin during 2022 and 23 on the Class A notes is likely due to expected deterioration of performance owing to the higher cost of living and higher interest rates adversely affecting borrowers, as well as RMBS market volatility. RMBS spread tightening observed so far in 2024 is likely due to general interest rate stabilization, supported by the fact that, notwithstanding the increase in delinquencies, mortgage defaults and losses have not meaningfully increased. Now, KBRA did the same exercise where the Class A margins were tracked by the type of collateral, that is, owner-occupied versus buy-to-let, mixed portfolios of owner-occupied and buy-to-let, a mix of first and second liens, exclusively second lien portfolios, and others. Now, the curves in figure 7 in the report generally reflect the tightening of Class A margins since 2019. Class A margins involving second liens were relatively higher when issuance backed by this collateral was first securitized in 2016. Since then, the better than expected performance for second liens has resulted in a tightening of senior tranche margins. Observed losses are small and comparable to that of other less riskier collateral types, supporting spread tightening. Increased margins since 2022 are largely driven by the broader market movements when riskier second lien issuance ended up wider by comparison.
Very interesting. Kind of leads us into the central pillar of the report, at least from an investor perspective, and that is excess spread. How do you see this element of the market developing?
Right. So just to let the audience broad definition of how we look at excess spread in RMBS transactions. So excess spread is a function of the weighted average coupon of the collateral, the degree of prepayments, delinquencies and defaults, senior items, the payments waterfall in an RMBS, the payments on the rated notes, and any credits to the principal deficiency ledgers. Now, a positive excess spread helps not only recoup realized losses, but also allow for payments on excess spread notes and an accelerated amortization of rated notes, typically post-margin step-up date in most transactions. Now, KBRA, in its report, illustrates the dynamics of the influence on excess spread by tracking the variance in the weighted average coupon of a securitized portfolio, the weighted average swap rate, and the weighted average Class A margins. In 2018, for example, weighted average excess spread near the closing of a transaction fell over 1%. This was largely driven by the combined effect of the variance in the WACC of the collateral, swap rates, and interest rate margin payable on the rated notes. Excess spread at the time of new issuance in 2022 and 23 in comparison reduced relative to that observed for issuances in 2021. And the combined effect of an increase in swap rates and interest liabilities on the rated notes as the Bank of England raised interest rates on one hand, and securitization of mortgage loans originated at lower fixed interest rates from the past on the other, drove the excess spread down in these years. The subsequent increase in excess spread in 2023 to year to date is attributed to the setting of higher mortgage rates for new originations from the start of 2022, resulting in a rise in WACC for securitized portfolios during this period, when the increase in swap rates slowed down. Now, the dynamics on excess spread is also illustrated in the report by the tracking of the weighted average excess spread at the most recent interest payment date in RMBS transactions, and is influenced by prepayments and the proportion of delinquencies and defaults in the respective portfolios. And I stated at the beginning, these excess spread dynamics are important to understand, as a positive excess spread helps not only recoup realized losses, but also allow for payments on excess spread notes and accelerate the amortization of rated notes. The dynamics of the interest rate cut expectations, swap rates, the mortgage rates, and the investor expectations on the Class A interest rate will influence excess spread going forward.
Thank you very much, Kali. Now, if we turn and have a look at what may be concerning individual investors in these products, now that rate rises have started to impact upon borrowers and the cost of living, investors may have some concerns about these products, as they're not, as we've said before, lending to prime borrowers. So how have they been performing in the current environment?
So in general, the specialist lender sector collateral performance is expected to be relatively worse than that of prime originations in the UK, due to the fact that the SLS largely serves the demand of the underserved borrower segment, which does not easily have access to credit by banks and building societies. The SLS collateral weighted average performance for example, the 30 days past due metric shows performance was adversely affected through the pandemic and was worse compared to prime in the buy-to-let portfolios. Arrears reached a peak of 2.8% in Q1 2021 and then declined to 1.6% in Q1 2022 post the lockdown period. All the mortgage subsectors, i.e. prime, buy-to-let, and the specialist lender sector portfolios show an increasing trend in arrears since Q1 2022, and the pace of increase picked up starting Q1 2023 when interest rates began rising. While the performance of prime portfolios has stabilized in 2024 and currently showing a reduced trend, SLS performance continues to worsen with arrears at 3.2% as of Q2 2024. Now, the specialist lender sector performance has deteriorated faster as high cost of living and increasing interest rates affected these borrowers. A similar trend is observed for the weighted average performance of loans in arrears for more than 90 days for the originations by the specialist lending sector. But the levels of the 90 days plus metric is at a lower level compared to the 30 days plus metric. Repossessions and realized losses amongst the specialist lender sector collateral are de minimis to date, mitigated by proactive early arrears management policies, low unemployment, lower loan-to-value originations, and the rise in house prices since the pandemic era.
Great. And I guess, again, a concern is as we sort of see this slight deterioration in performance, as you said, it's not been dramatic, but it is deteriorating. How well protected do you think these transactions are to any sort of a decline in performance going forward?
So in general, the specialist lender sector's servicing capabilities benefit from the experience gained post-global financial crisis and the pandemic period dealing with borrowers in financial stress due to unemployment or reduced income levels. And this definitely is a strong aspect of the specialist lending sector, which is better prepared to deal with performance stress now and in the future. The specialist lending sector issuance is also appropriately better protected for decline in performance of riskier products due to the prevalence of a positive excess spread even during the ongoing performance pressure environment. A combination of lower LTVs and positive excess spread have helped mitigate observed losses, which in themselves have been at very low levels. The high prepayment levels around the dates of the end of the fixed rate period in these portfolios can compress excess spread, reducing the ability to absorb losses on one hand, but also reduce the issuer's interest liability and amortized notes to the extent of the prepayments on the other.
Great. Thank you very much, Kali. This is a very interesting discussion. So, as we have heard today, the specialist lender market does provide borrowers with a number of products that help to expand lending to non-traditional sectors. And some sectors are currently experiencing an increase in stress, but not to a worrying level at this point. Increased protections, though, put in place, such as higher excess spread and lower LTV, as Kali just mentioned, help to ensure that transactions can weather these times of increased delinquencies. KBRA does not expect the use of securitization market by specialist lenders to diminish, but it is instead likely to continue to expand. This market has matured during the past 10 years, partly thanks to the funding available through the securitization market. Their proportion of the market will diminish as traditional bank lenders return, but the use of securitization does play a key role in their funding. And as we have heard, the structures that have developed to cater to these products offer protection commensurate with their differentiated collateral. That's it from us today. Thank you very much for listening. As always, we hope these conversations in credit help to illuminate the many trends taking shape across the markets. For more in-depth coverage of the themes discussed today, or to learn more about our unique approach to credit, sign up to the KBRA website to read all of our research. If you have a topic idea or comment you'd like to share, please reach out to me or one of the KBRA analysts on today's episode. Be sure to rate, share, like, and subscribe to this podcast so you can be notified when new content is available. Invite your colleagues as well. We'd love to count you all as informed listeners. This is Gordon Kerr, thanking you for being part of the conversation. Take care, everyone.